Hi, Adam.
Hi Dale, how are you
I'm
doing?
doing fine. Thanks so much for coming back after my Time Warner internet failed in the middle of our talk on Wednesday. Appreciate you.
Well, that
Appreciate you.
certainly happy to do that. We have all dealt with technology
Yeah,
gremlins at one point or another. So,
yeah. So, we covered a lot about your background and philosophy. Maybe you could just give our community just a quick background on what you're doing now, and then perhaps we could get to a screen share and get to the meat of what's happening here in the markets.
sure. So I've been trading about 20 years, pretty much all markets, all time frames, futures, options, equities, forex, everything. But currently, I am the CIO of Waverly Advisors, and our website is waverlyadvisors.com. You can also check out my blog, which you probably given them the contact information, but adamhgrimes.com.
Okay.
I write a lot there on my approach to market, which is a technical approach, but I would actually say more technical quantitative. My everything I do has to stand up to rigid statistical tests. And this means that so many of the things that fall under that umbrella of traditional technical analysis, I don't use. And that, doesn't mean that somebody has not found utility in them, and there certainly could be. We always have to remain humble. There could be things that I'm missing in my tests, but so my approach is a combination of quantitative, technical, with a little bit of macro and fundamental awareness mixed in. So I guess you'd call it more of a blended
Many
approach.
ways to skin a cat, right, Adam? So,
Absolutely, it's very
so
true.
we find things that give us conviction to make things compelling enough for us to take some risk on our ideas. Perhaps we could go to the screen now, and with this big recovery in S&Ps and what a difference a week makes. We were on the verge of breaking down under 1900, and here we are. Uh, we've retraced over 61.8 here on this bounce in the S&Ps. Where's your head at in the markets right now? What are you telling people at Waverly Advisors on both the macro and micro level?
So Sure. So I just shared the
Got
screen.
it.
Is the screen
Yeah,
share
it
working
looks
today?
good.
Good. Oh, okay. So this recovery in the S&P is really what we have been looking for. I do think that there is a bigger picture issue to consider here, which is that this recovery is probably setting up another downswing. Now, it's really important, and I'm sure something everybody listening knows, it's very important to clarify your time frame. Are you an intraday
Right.
trader? Do you hold things for 2 weeks? Are you a long-term
Hmm.
investor? And I think a lot of the mistakes that people make and a lot of the pain people suffer in markets comes from getting confused with, where am I in, you say you're a longer-term investor and then the market breaks down 6% and you're panicking. That, frankly, we see that a lot.
Right.
And the longer term investor has to kind of have the, like it's the difference between a little yappy dog on the street and a big dog that just doesn't care about anything. And, the long term
No
investor has to be
mental.
the big dog,
Yeah.
say market went down 12%. I don't care. What do I care? I'm in for the long haul. So, this more than ever, I think, is a time where you have to clarify that. And we do see a very bullish longer term setup for equities. And my personal belief on everything I see, people are talking about this historic bull market. I think the history books will say that we're at the beginning or maybe the late beginning of the historic bull
So you
market.
didn't like the
Yeah.
24, 2500 camp in S&Ps?
Possibly significantly beyond that. I'm looking at what I would expect a 5 to 8 year bull market from current levels. Now,
Wow.
before we do that, we certainly could have a substantial 20 to 25% pullback.
Okay.
And for the longer term investor, that's business as usual. You can't be terribly concerned about that. For the shorter term investor, their shorter term trader rather, there are going to be plenty of opportunities to play the short side. So what I think we are setting up in equities is I would be if you're long here, I would be pretty tight with the stops. And, good for you for being long. That's great. I suspect that, and probably next week, we'll have another significant downswing. I would not be at all surprised to retest those early August lows. And now this next sell-off, thinking several steps ahead, I would expect that sell-off also to fail and to be a spot where we could probably look to establish some more swing long positions. But what we're seeing here, like I have the S&P on the screen, and if I flip back and forth between the indexes, here's the Russell. It's more important today than it was several years ago to think about the world as a whole. Here is Europe, and when I look at Europe, I see a pattern here that could be a little bit of a selling climax in early August. Still, it would be relatively unusual to see a sell-off of this magnitude, which if you look on the weekly, we've reached my lower Keltner channel. And I firmly believe, I guess I should also say that, I believe that there are no magic lines or magic numbers in the market. And I believe that based on the fact that I have just been completely unable to substantiate any value. You turn on the news, you hear every day stock XYZ is finding support at its 50-day moving average.
Yeah.
Well, statistically speaking, that doesn't happen. Because that's just not something we can pull out of the prices in a quantitative, any kind of significant, meaningful way. So when I talk about these bands and what I have on my screen, I use a 20-period exponential moving average, and I have Keltner channels. I think they're set 2.25 average true ranges around that moving average. It's just a reference. It's just a way to say the rubber band is stretched a little bit here. And we certainly can make some comparisons. Like if we look at the weekly, let me go back to the S&P. If we look at the weekly, actually, I guess Europe was better. We've touched this lower Keltner channel here for the first time since 2012. So, that's just in case we didn't know, and of course we all know, this recent sell-off has been significant. If you look at the market structure in the S&P, we're still holding a year-and-a-half long trend line. We're still nowhere close to this bottom Keltner channel, which again, in the S&P, we have not been there since 2011. So, well, currently, it moves every week, but currently a little bit above 1,800. Okay. My reasonable target for a pullback, for a large-scale pullback, would probably be somewhere in the mid-1700s. Okay. And, that would also be probably enough price movement to tip a lot of the commentators and a lot of the media to... I get concerned when everybody sees the same trade I did. Right. We've been bullish on stocks for years, and increasingly concerned 2013, everybody kind of starts to become bullish. And I think what would be very healthy for this market is the kind of pullback, and we understand price structure wise what pullbacks do, but psychologically it also gets people a little bit more fearful and readjusts some of that bullish bearish bias in the market. And because really what moves markets is not somebody being bullish or bearish. I think it's really people switching camps. So if we have a few more people who think the market's going to crash, that's good. That would make me very, very happy as a bull in stocks to see more people afraid and see more people thinking bear market.
1750 would do that.
1750. I mean, depending how we get there. Certainly, if we get there in a couple of weeks, it would be outright panic in many quarters. But even if we grind down there over the course of 3 or 4 months, that still should do that, I would think.
Any view on our bailiwick here is FX? Any view on the dollar? The dollar's been acting pretty good lately. I can't find a euro bull out there. I mean, everyone that talks about the euro is either talking about downside targets or where they would short it. You have any view on euro or any of the currencies?
Well, I think one thing in terms of environment, again, this depends on your time frame. If you're day trading currencies, this doesn't apply. But if you're looking to hold for swings, let's say 1 week to 3 months. I think we've had pretty much across the board an exceptionally difficult trading environment for the past. It's been a while, for the past maybe 2 years. We've seen a lot more fake outs than we usually do in currencies. We've seen a lot of patterns break down. So I think, first of all, any forecast we could make, anything we can discuss here, has to have but you have to take it with a pretty big grain of salt and just say this has been a very difficult environment. Having said that, we've been short the euro for a while, so we were fortunate to catch that. We were also long the pound and got out of that on the reversal. I think what we see, I'll pull up. I'm not a huge fan of the U.S. dollar index because so much of it is you're basically looking at the euro, right? Right. But looking at the U.S. dollar index, which people do like to talk about, what I have been saying for most of the summer is that we see some short-term upside and we don't really see longer-term support for a bigger move. Now, that is changing over the past few weeks, and with this tight consolidation this is the cash dollar index, with this tight consolidation, this does seem to be setting a stage to head back to these 2018 highs. And if I put up probably more relevant market is the euro. I think the same thing. We could certainly be looking at seeing the euro down to 1.27 or so. And that's, again, I would expect that to be difficult trading with a lot of stops and starts and a lot of consolidation. So if you're going to swing that, you're probably going to swing it with reasonably wide stops. I said you need tight stops on stocks. This is a point with the euro where I'd kind of step back, get a little bit more room to move. There is something kind of interesting happening in the euro this week. If you look, we have a series on the daily chart of you can call them multiple inside bars, but what it really points to is a type of volatility compression. And we all like to talk about volatility. Everybody talks about the VIX, and I think a lot of people talk about volatility and aren't really sure what to do with it. But there are times when volatility, which of course is a non-directional aspect of market behavior. If we talk about something being volatile, you don't necessarily know if it's going up or going down. But when we see volatility kind of ratchet down, when you see volatility, a good way to think about it is like it's coiling. Yes. You're storing this energy. That does many times.
It's compressed.
Yeah, it is compression, exactly. And that does set the stage for a relatively clean,
sharp
direction move. So that seems to be what we may be setting up in the euro, and everything we see seems to favor the downside. But of course, like I said, these are difficult markets that certainly deserve respect.
Adam, I correlate action in the yen with treasuries, and that correlation seems to be breaking down a little bit lately. Treasuries making new highs, TLT new highs, yields under 240, while the yen is still above. The way we traded here in Cash FX is U.S. dollar yen instead of yen dollar, well above the support levels of a month or so ago. Which one's right? Are the bonds right and U.S. dollar yen's headed lower, or is the yen right and it's going to continue to go up, and maybe all we did this last year, since last year in the yen, is move sideways and work off an overbought condition in time rather than price?
Possibly. I do a lot of work with correlation and co-integration and looking at these relationships between markets, and a lot, as you've just said, a lot of these correlations are not as stable and perhaps not meaningful as people think they are. It makes it much more difficult than people would think to say implement a hedge based on correlation or
yeah, it's gotten me in trouble.
Offset risk.
Yeah.
It's very, very difficult.
Yeah.
Yeah, and I think one of the things that's a little bit interesting about my quantitative work is I kind of try to do everything with a very blunt stick. It's the difference between, if you're going to be out in the wilderness, do you want a modern laptop computer and all of these finely honed tools, or do you want a coil of rope and a sharp knife? And in the quantitative world, there's so much noise and so much randomness, and the things that work within such a noisy band of probabilities that I find the sharp knife approach, it's a blunt stick, whatever, So in other words, I don't really put a lot of weight on a lot of these relationships. Okay. The yen, we can discuss yen and treasuries separately. Okay. The yen, to me, for 2014 has kind of been hands-off from a swing perspective. As you said, it's just in a very large, very noisy trading range. Within these ranges, price movement is mostly random on those time frames. However, one thing that a lot of people don't know, it's not as simple as saying, okay, the yen is consolidating, it's in a trading range, I'm going to avoid it, I'm not going to trade it until it gets outside of that range. Now, that's appropriate for, I'm assuming that a lot of the people listening here are probably trading on shorter time frames. What I just said is appropriate for a swing trader. But what people don't realize is that when you have a time frame that is consolidating, the sharpest and the cleanest and the best lower time frame trends come within those consolidation areas.
That's
so
a pro.
If you're
right there, that's a pro. I've never heard that before. So that's very interesting. So people complaining about tight ranges and smaller ATRs, they're getting cleaner entries, exits on their 60-minute chart.
Well, perhaps, if at some point volatility becomes a problem, like if we were to return to an environment where the average daily range of the S&Ps was 4 points, you would have a difficult time day trading the S&Ps. You have to have a certain amount of movement, but if you're a day trader, you don't have any reason to complain about a daily chart being in a noisy range with a lot of reversals. That's what you want. And you may be able to read some of the structural inflections in that range, which is a little bit harder, again, because I said those ranges are more random. But if you just focus your attention on your market, on your lower time frame, which is where you live, where you're trading, there really are some fantastic trends within those very difficult daily areas.
Anything in the commodity arena that you're monitoring or looking at?
We can hit treasuries quickly, too, before moving on. I think there's a long trade in treasuries. We are long treasuries, have been long treasuries. And I realize that's to, again, it depends on how you trade and, what you think. But if you... I'm sorry, I've read an email, totally lost my train of thought. If you have your trading methodology, you have to ignore what the rest of the world says. The rest of the world is absolutely certain that rates are going to rise. Well, I'm far from certain rates are going to rise on any time frame. I just don't know. I can't predict the future. The other thing that so then you have to be careful of making too simplistic connections. If rates rise, will Treasury futures necessarily go down? And the answer to that is no, because of the way they're priced. There's a lot of other factors that go into that. And even if Treasury futures go down, are you trading TLT? Well, TLT, so there are a lot of chains here where things could break down, and it's really important. What we see, I guess, as I'm rambling about Treasuries, I could put a chart up. Here's Treasuries. Here's the 30 years. We hold a long position in the 30 years and have for a little while here. The German, the Euro bonds, Bunds,
under a 200-year low.
So really everything there looks.
It's like a 200-year low, isn't it? It's
just fantastic. Yes, absolutely.
I barely remember that.
Me too. back in the day, it's so everything we see seems to point to continued long trades and rate futures. And when those trades are wrong, I'm not going to sit around and wring my hands and try to predict the future and worry about the news, because when my stops are hit, I'm just going to get out of the trade. It's pretty simple. You want to hit some commodities. So one thing that we are looking at, we had a short entry in natural gas futures this week. Had a long trade that really, a longer term long trade playing for a trend reversal. And actually, if I can look at the monthly chart here, let me set that to... I think on your longer term charts, it's pretty important to use a log scale. For shorter term charts, I would use a linear scale, but that's something I think is very important. When you have a big price change, say if you have a chart that includes an over 100% move, which is not uncommon in a lot of stocks or longer term commodity charts, you probably want to use a log scale. And here you can see clearly the we have been playing for most of 3 years here with some kind of what looks like change. And so we had an attempt earlier this year at catching that trend change. The trade was stopped out for a small loss, which is absolutely fine. And now I think there's probably a pretty good chance we're heading back to some of these lows. If you trade UNG, and I would not, by the way, but the reference level on that would be roughly 14.5, which is not a huge move, but maybe a little bit of price movement there. Okay. Precious metals, we're very focused on precious metals, and right now what we see in precious metals is, here's gold futures on the screen, and if you look at the monthly chart in the upper left, we see that same kind of volatility compression that we were talking about in the dollar. So now, however, this pattern extends back to early 2013, where you have, and actually if you can look down at my swing chart here, I think you can see a little bit more clearly. So what this is telling me is we probably are setting up a move in treasuries. I have treasuries on the brain, and gold. But this move could come 2015, 2016. So I see this market, on the shorter time frames just being locked in a lot of noise. I think the trades that are there are going to be very quick 1 and 2 day trades, and you may find some quick pops, but
the long-term,
if you just consider metals,
the long-term buying opportunity is still a ways off, according to your work.
Well, actually, I think there's probably another really hefty downswing, and people get very emotional and even very angry when I say this sometimes, but I don't see a buying opportunity. I see potential for gold down to maybe 850, and at which point, maybe we'll have a buying opportunity there. Certainly that could change. Okay, certainly, that I don't have a position in gold now, but that's kind of the. So what I would do with that is, so okay, that's what I see structurally, and then I would wait for a sharp move on the weekly chart and look to trade the first consolidation. And that sharp move, by the way, could be up. It could be evidence that I'm wrong with my bear call, and that's
how about like back above the mid band on your Keltner there.
To me, that wouldn't be terribly meaningful. Depending how it happened. So what I would want to see would be a very, very sharp up week. A week that's maybe 100 points on the futures, maybe more, and just something that shows me that volatility is back in the market. Interesting thing about volatility in metals, we think about volatility with stocks as being when stocks go down, the VIX goes up. Volatility in currencies and in metals, most commodities, is much more symmetrical. So we certainly could have a lot of increased volatility as gold rallies. And you think about economically and macro, headline-wise, what could cause that to happen? It kind of makes sense. So that, if I saw a very sharp upward move and then a consolidation, that would get me interested. But I don't really see, breaking any particular levels. Even, I wouldn't be surprised to go flirt with the mid 1400s and maybe get some more people leaning bullish on gold before turning down. That certainly could happen. So I would just be very careful. Assume that most of what you see is smoke and mirrors and deception.
Great interview, Adam. You want to show your website or blog so people could take a look at that? And
Sure.
And how they could continue to get your analysis as a retail person?
Absolutely. Thank you. So I've actually tried my hand at a little bit of web design here recently. I've redesigned all my websites. Let this load for some minutes. So my site is adamhgrimes.com. That will take you directly to my blog. I also have, and I will just mention this, I have a free trading course, which you can link here from the art and science. You also
from your book, right?
Well, it is. It is. It's kind of the companion to my book because I was looking for. So you can find all of this from adamhgrimes.com. I was looking for a way to really. The book is a good reference. I think the book has everything you need to know to trade successfully technically, but there's a lot of behavioral stuff. And one thing about the course includes a lot of psychological work, a lot of meditation and trance work that has really been very, very well received. And I'm hearing all kinds of things about positive changes that it's made for people. And it's completely free. That's something, obviously I do, my firm Waverly Advisors, and let me pull up that website. I do sell research here. And, we'd certainly love to have you check out our research. We have quite a bit of information here. We have samples. We cover the currencies. We're not focused on the currencies. I would say our focus is probably maybe 2/3 equities, and then maybe the remaining third is split evenly between commodities and forex. We do a decent amount with options, but you can check out samples and then just shoot us a request for a trial. We'd certainly be happy to have you take a look at our work. And then, if you're in the process of kind of developing your own trading system, I'd also encourage you to take a look at my course. There's 20 hours of video there. I think maybe another 6 or 7 hours of audio. And this is something that I put out there is, I'm a very cynical person, so I'm always wondering, what's his angle? What's this guy trying to do? I really wanted to put a course out there that was was certainly the equal, if not better, than a lot of the things people are being charged a lot of money for, and that was just based on kind of my frustration with seeing how the public was being bamboozled with $5 and $10 and even $15 and $20,000 trading courses that really didn't add value. And so this is kind of my shot at that, and I think there's really good material there. So please, if you're at all interested, check it out. And I'd also encourage you to check out my research if that would be down your alley.
Adam, thank you so much, and you're now my nominee for the Nobel Peace Prize for Humanitarianism. On offering this,
thank you.
On offering this course. It's really been a pleasure listening to you and meeting you, and it's my hope that we could get back together sometime in the fall and revisit where the markets are.
I would like that. Be happy to do that.
Have a great weekend, my friend. Good hunting, and thank you for your time.
Same to you. Thank you. Adam. Take care.